And Dr. Stephen Nash from FIIG Securities with us. Dr. Nash, welcome into the show. Really, if we start maybe close to home now, and RBA's agenda, kind of clock-ticking territory yet again for rates. What's been the latest bit of information that you've settled on to suggest a move either which way?
Look, we had the wage cost index data out yesterday indicating that wages getting very close to a comfort level of around 4% for the RBA. The RBA have indicated that they're concerned about wages, costs and lack of productivity growth. We've got more data out today with the awaiting numbers, and hopefully we'll see continued moderation there. The market was reasonably happy with the output yesterday. And if you look at employment growth, it would suggest that wage costs should moderate going forward, so that may sway the RBA going forward, but still we haven't got enough information to be definitive on that.
So you're saying what expectations more broadly are that we'll see unemployment rise and therefore take some of that pressure off a blowout in wage demands?
Yeah, the momentum in terms of employment growth is slowing, so that would indicate that we should see the pressure coming off the RBA. Yeah, I agree with that, yeah.
What's interesting, Dr. Nash, more broadly, we're seeing these falls in fixed rates.
Yeah.
You've said, though, doesn't at all have a bearing on the future course of the OCR itself, the official cash rate set by the Reserve.
Look, what we've seen is the long end of the market rally significantly. Also, three-year bonds are very expensive at the moment. The market building a lot of easing, really on an emergency view of growth expectations and particularly what's going on in the US at the moment. So in terms of the short rate, we really have to see some stabilisation in terms of what's going on in the global scene. Now, a gradual improvement there would imply equity prices to rise slowly, and that would allow the RBA to refocus on this problem they've got with productivity, and I think that's really what's going to happen in the next few months.
Well, if you look at the growth story coming out of Europe, of course, that region's largest economy is looking pretty dicey. It's dancing with recession.
Yeah, the German figures released recently indicate that growth in that economy is getting a bit slower. The Bank of England last night, some of the members who've been advocating rises in rates have backed off on that. We've seen some comment from people like PricewaterhouseCoopers arguing that allocation to equities has really been a bit of a disaster for people in the UK, and I think the same story applies here.
Gosh, breaking news from your point of view, Stephen. I mean, you would be saying that in many respects.
Well, I think what they're saying is quite reasonable. All they're saying is that as people approach retirement, they should be lifestyling their investments, getting more fixed income. With 9 to 10% investment grade yields in Australia, there's really no excuse not to get some of those fixed income securities on board.
I guess you could strip all the verbiage away and say, as a defensive strategy, that is, I guess, the way to go. You're saying this is not the time to be taking any kind of risk. Take risk off the table because of everything that's going on.
All we're saying is, one, be calm. Two, just consider your portfolio allocation, and then broadly over time move it more towards fixed income in a controlled and careful way. So we're not saying at all to panic. Obviously, growth assets are very important to portfolios, but we're saying that there should be a greater emphasis on the fixed income side.
Do you think that investors, though, are getting decidedly confused on that one, because the mixed message they get from the super allocation that's out of their control often, unless they manage it themselves, are the skew there very much the other way? Say a 70-30 mix, and it's not into fixed income, it's into equities of 70%.
Yeah, I think the default allocation in Australia is probably too aggressive in terms of equities. 70% to 80% equities is just too aggressive. What other economies have done is, as I said, they do that lifestyle approach where they reduce the balance to equities over time, and I think that's a really good way to roll people into a more conservative asset mix as they get a little bit older.
Any signs that there's going to be an uptake on that one? We've had the super review. What was the conclusion on that front?
Look, in terms of asset allocation, it was not very definitive. There seems to be an overall bias towards growth assets, and a lot of industry funds still are holding on to that approach. But I think recent market turbulence is just bending the resolve there, and hopefully we can get a little bit of movement over time.
Speaking of market turbulence and resolve inside the Fed now, given some latest comments by officials there, an internal debate very much raging, which you could say is a healthy thing to be having in this environment.
Yeah.
But what's the likely tussle going to result in?
Look, I think the majority will carry the day here, and the majority, I think, in terms of Bernanke, have been correct, in the sense that they've been looking at lower growth for longer. I think the statement by the Fed is designed to prevent, your typical investment bank saying the Fed is going to tighten in the next 6 months. They've been saying for the last 2 years. They've been wrong, and I think the Fed want the market to know that they'll have a fairly low cash rate for an extended period, so that when they embark on QE3, that rates will not rise as much as they do when they initiated QE2. I think they want to control those longer-term fixed income rates, and they want to ensure that people can borrow at cheap levels.
Will they be looking for a catalyst on jobs, housing, or merely a set-piece moment in time like Jackson Hole to roll that program out?
Look, I think there'll be a lot of discussion at Jackson Hole on this, and yeah, the employment numbers have just been completely disappointing for a long period of time. I think everyone knows that. I think we've already had, a lot of stimulus towards the idea of further quantitative easing with the recent turbulence. So growth expectations are low. There is talk at the moment that the US is already in recession. So I think that discussion will, I think Jackson Hole possibly be a venue for announcing some sort of extra easing, yeah.
All right, interesting remarks from Mr. Parry on that front as well. What do you make of those treason comments?
Look, I think it's just including the Fed in this political debate, which is now going to go on for the next 12 months in terms of the election in the US. So even the Fed is getting drawn into this political situation, and the focus is going off policy back onto politics. I think Obama is trying to steer the administration onto getting policies that really create jobs. I think that's the really important thing for the global economy right now.
Yeah. He's left us run a bit late, hasn't he? They're already into campaign mode.
I think, yeah, very much. Everyone's in campaign mode, so hopefully the Fed can stay out of that and make sure that we've got enough stimulus to get this economy lifted, because it's very important for global growth right now.
Indeed it is. World's largest economy. It's not going to buckle on that score anytime soon. Dr. Nash, thank you. Have a good day.
Thanks very much.
Stephen Nash from FIIG Securities.